Hello, my name is Richard Wood. It's the 24th of November 2013. I'm going to quickly summarise the events of the global financial market for the week just gone and take a look at the coming week ahead. Central bank announcements dominated the news last week. The minutes of the last FOMC meeting were released and were more hawkish than were anticipated. The FOMC members seem keen to see the tapering of the asset purchase scheme begin sooner rather than later. The minutes, however, did show a commitment to low interest rates for the foreseeable future. The Bank of Japan reiterated its commitment to double its monetary base within the next 2 years and also stressed that they do not feel the yen is weak at the moment. In the Eurozone, Mario Draghi played down the likelihood of a negative interest rate in the Euro area, and the heads of the Bank of Australia in a press conference stated that they would not rule out intervention in the currency markets. The combined effect of the various news events of last week were that mid-dated US Treasuries moved out slightly. Equities dipped on the release of the Fed minutes, but actually came back fairly strong towards the end of the week, and most indices finished the week up. The yen was a big faller, very weak. The Aussie dollar also fell off the back of the currency intervention comments. The euro was firmer with the lower probability of a negative interest rate, and the pound was very strong as people bet that the Bank of England would be the first central bank that had to increase interest rates in the face of a more sustained economic recovery. In terms of trades from last week, I had been long on the US dollar yen for a number of weeks. I'd moved stop loss up to try and lock in some profit, and the stop loss was actually hit last week. Unfortunately, around the lows of the week before the market recovered and price continued to go up. However, I did make a profit roughly 3 times the amount of risk, so I have to be happy with that, although slightly frustrated that I'm not in now for what I feel will be a more sustained move higher. It took a short trade last week on the New Zealand dollar against the US dollar. That was a fairly short-lived trade that again came out with a profit of roughly 3 times the amount risked. So fairly profitable week last week. Looking at ideas going forward, I'm expecting the Bank of Japan to have to inject further stimulus to achieve its targets that I spoke about a couple of moments ago. That should further weaken the yen. I don't think they're going to announce the stimulus for a good few months, probably sometime in 2014. However, as the market increases its expectations of that announcement coming, then the yen should continue to weaken further. So I'll be looking for opportunities to short the yen again. I'm also looking for more weakness in the Aussie dollar following the news conference of last week, where they wouldn't take the possibility of currency intervention off the table. I'm hoping for a retracement on the Aussie dollar against the US dollar back to the 0.9275, 0.93 area, and then I'll be looking for some sell signals from that price. Depending on how the gold market opens up tonight, I'll probably enter a order to short gold. I'll post the details of the entry on the blog. I just want to see the market open first and make sure there's no big gap one way or the other, but keep an eye on the blog to see if I enter an order there. One of the one of the themes of the last few months has been the strength in stocks in face of the likely tapering from the Fed. Stocks carried on rising this week after a small blip when the Fed minutes were released, and the question is really how much further can they go? There's evidence that people are now rotating out of bonds and into stocks, so that has 2 effects. One, it's going to put more money into stocks, which means more people will be buying. Basic supply and demand, the price should go up. However, as people are selling out of bonds, that's going to put upward pressure on interest rates. Furthermore, when the tapering process does begin, that's another upward influencer of interest rates. So I'm thinking at some point the increase in interest rates is really going to take the steam out of stocks, and at some point there's going to be a big fall. I'm not alone in thinking that, and there's been a lot of popular comment along the same lines. The big question is when that's going to happen. I think the important thing to remember at the moment is that the tapering process is just that, it's tapering. Even though the amount of bonds being purchased by the Fed will decrease, they're still going to be active in the markets and still going to be buying those bonds. So I think the growth in the price of equities can continue for some time yet. So I'll be looking for long positions in stocks. That is caveated by the expectation that at some point, and it could even be a year or two away, there's going to be an almighty sell-off, in my opinion, in stocks. All the people who are now moving out of bonds and into stocks just mean that there's more people who are going to be caught the wrong side of the market when this fall does come. And the more people that get caught the wrong side of the market, normally the bigger the fall in prices. So that's more of a long-term view. In the short term, I'm going to be looking for long stock positions. Looking at the data for next week, the economic releases, I'd recommend that you have a look at an economic calendar and rather than me just rattling off what's going to happen day by day, as I normally do. However, as time's short, just quickly cover off the main events. US consumer confidence figures and durable good numbers are out this week. In the UK and Canada, we've got GDP figures, and there are CPI figures out for the Eurozone and Japan. In terms of market moving events, the CPI figures for the Eurozone and Japan could be the ones to watch, so keep an eye on those. As usual, if you're trading this week, best of luck to you. Thank you for watching the video